Let us say you are planning to invest in the stock market and you have shortlisted some three shares. Let us say all the three shares are belonging to the same sector. For simplicity, let's say the three shares are A Limited, B Limited, and C Limited. As I said, all the three are belonging to the same sector. Maybe they are belonging to the pharma sector or the IT sector or the cement sector, or maybe they are all banking stocks. Doesn't matter. They all belong to the same sector. You are now planning to select any one of those shares for the purpose of investment. So either I will invest in A, or I will invest in B, or I will invest in C. I want to now decide which is the best company for my investment. How do we normally approach this kind of a situation? Put yourself in the shoes of the investor. You want to select which is the best share for investment. Of course, you will study the sector, you will study the three companies, you will try to understand their business model, you will try to understand what are their future prospects. Not only that, you will even study their annual reports, right? More importantly, you will be studying the balance sheets, the P&L, the cash flow statements, and then you will be doing some kind of ratio analysis. There are quite a few ratios which are very popular amongst the investors, right? For example, ratios like you may calculate return on equity, or a very popular ratio is the return on capital employed. You may even work out the EPS. You may even calculate the earnings yield, dividend yield, PE ratio, right? The price earnings ratio. So different ratios will be determined, and we will like to compare on the basis of the ratios the different companies. Let us say you have decided to select the return on capital employed. So let's say my calculations are showing that the ROCE of A is 15%, for B it is 25%, and for C it is 20%. So I work out the ROCE, and I'll tell you one thing. Nowadays, a lot of published literature is also available. Understand? If you do not have the time to do this analysis, a lot of literature is available. Online, it is available. There are so many magazines which are dedicated to the stock market. And from there also, you will be in a position to get all these ratios. And on the basis of that, a lot of investors make investments. If A, B, and C are all belonging to the same sector, and if the ROCE of B is 25%, then perhaps the company that you want to invest in is company B Limited, isn't it? So you like to put your money in B Limited. Why B Limited? Because B Limited has the highest ROCE. Right. So I am judging the companies on the basis of ROCE, and I realize that the company B has the highest ROCE of 25%. And that is the reason, as an investor, I decide that let me put my money in the shares of B Limited. This is what majority of the investors do. But I'll tell you, this is a wrong way of selecting a share. I'm trying to build the entire concept of economic value added for you. I really want to pinpoint that where exactly investors go wrong. You may be of the view that, see, all the three companies are belonging to the same sector. All the three companies are compared on the basis of ROCE. B has the highest ROCE of 25%. So we should invest in the shares of company B. What is wrong in it? You may really feel that what is wrong in this investment strategy? Ask yourself, what is wrong in this investment strategy? You are judging companies only on the basis of the return that they are generating. A very important question you are not asking yourself as an investor. What is the question that you are not asking yourself? The question that you are not asking yourself is whether this return is sufficient or not. See, this question you are not asking at all. You are simply looking at 25% of, your eyes are on the highest figure, 25%. Yes, 25%. So company B is best for investment. This is how you are selecting the company for investment. Are you asking the question that why company B is giving such a high return? It's quite possible that company B is highly leveraged. Leveraged means it is employing a huge amount of debt. And because it has a huge amount of debt, the financial risk of an equity investor will be on a higher side. right? So quite possible that although your eyes are on 25%, which is the highest return, but that company may be giving you the highest return only because the risk is also on a higher side, isn't it? You are not asking yourself as an investor that how much return I should get from this particular share, isn't it? You are judging companies on the basis of the reported ratios. Return on equity is highest. Okay, this is really good for investment. This company has a very high ROC, a very high dividend yield. So yes, let me invest in this company's share. This is how you are judging. You are not asking yourself that what is your own expectation. Just because the company is reporting a huge amount of profit does not mean I will invest in that share. Is that profit sufficient enough as per the expectations of the investor? Investors' expectations is what is missing over here. What are the investors' expectations? But the investor himself or herself is not asking this question, and that is the reason the companies get away. You are not asking this question. For example, in let's say this is the AGM of the company and I am the managing director and I make an announcement that this year our ROC has been 25%, everyone will start clapping that yes, such a good ROCE. Did you ask yourself what is your own expectation? Quite possible that as per the risk which is there in company B, your expected return is perhaps 30%. You are taking a huge amount of risk by investing in shares of company B. You will be compensated for the risk only if the company B earns at the rate of 30%. But you never asked this question. You simply looked at 25% and jumped the gun that this is the best company for investment, isn't it? This is what most of us are actually doing. Most of us simply look for higher returns. Wherever it is available, we put our money. And then there is also a chance of losing money because you are taking a higher risk. So considering the risk which is there in the company, are you getting sufficient return? It's quite possible that the investors expected returns, right? Over here is turning out to be 12%. Over here it is turning out to be 22%. So when I consider the risk which is inherent in the company's share, when I consider my expectations as an investor, I realize that I want 22% return, but I will get only 20%. So I will reject company C. I realize that I want 30% return, but the company will give only 25%. I reject B. And finally, I realize that as per my expectation, as per the risk which is inherent in the shares of company A, I am expecting 12% return, but company A is giving 15% return. It is giving me return more than my expectations, and hence I will select shares of company A. This is the rationale of this entire new term that we are going to study, economic value added. What is economic value added? Now let's understand this thing. Simply because a company is earning profits, so it is a good company for investment, is an outdated rationale. A company should earn profits in excess of the expectations of the investor. If the company is able to earn profits in excess of the expectations of investor, then the difference will be understood as EVA. It will have a positive economic value added, and if the EVA is positive, only then the shareholders' wealth will be maximized. Tell me, you know it very well. If you are the finance manager of a company, what is your main goal? If you are the finance manager of the company, what is your main goal? Your main goal is wealth maximization. Whose wealth? Not the wealth of the finance manager, the wealth of the shareholders. Okay. How will you maximize the wealth of a shareholder? Wealth of a shareholder can be maximized only in one way. The market price per share of the company should rise. If the MPS is rising on the stock market, automatically there shall be a rise in the wealth. Okay, so shareholders' wealth will be maximized by taking such decisions which will increase the MPS. Tell me, when will the NPS of the company rise? NPS of the company will rise not on account of good performance of the company. No. NPS of a company rises when a company performs better than expectations. Always keep this thing in mind. Always keep this in mind. Only because the company reported profit and the NPS will start rising. No. Come on, companies are doing business, right? Every company is doing a business. The goal of business itself is to earn profit. Okay, so earning profit is not sufficient. Earning profit is actually the most basic criteria. Come on. If I'm investing in shares of a company, obviously I'm expecting that company to earn profits. So you can't have such a basic thing like profit as a criteria that will increase the share price. Company share price will rise when it will earn profits in excess of the expectations. I was expecting that the profit will rise by 10%, but instead the profit has risen by 15%. Automatically, the company's share price will start rising on the stock market because company is faring better than the expectations. Getting it? So many times it is even observed on the stock market that a company reports a loss, still its share price rises. Have you ever seen this? The company reports a loss and still the share price rises. You know why? Because the company reported a loss less than the expectation of the investor. Investors were like that there will be a huge amount of loss. Instead, the company surprised everyone by reporting a lower amount of loss. The company's share price will start rising on the stock market. So, if you want to achieve the goal of wealth maximization as a finance manager, you have to ensure that the company is earning in excess of investors' expectations. This excess profit is what is popularly known as economic value added. EVA is basically a new measure of corporate surplus. It has taken the Western countries by a storm. In the Western countries, EVA has now become a very popular concept. So many companies have adopted EVA. So many companies have linked the pay packages of their top level management to the EVA. Instead of telling the top level management that we will give you 5% commission of profit, 5% commission of profit, instead of that, they are saying that your commission, your, what you can say, remuneration will be linked to the EVA. If the company produces positive EVA, then only you will get the necessary remuneration. Otherwise, you have to be satisfied maybe with a fixed amount of salary. So whatever incentives are there, the incentives have all got linked to the EVA. However, it's not so right now in India. In India, we are still having a fixation about profit, but sooner or later, this trend will catch up even in India also. How will I calculate the EVA? Yes, interesting question. How will I work out the EVA? The formula for EVA is OPAT minus TCE, this is T, TCE into WACC. This is what will give you the economic value added. This is a concept which has been developed by an American consultancy firm. Right, its name is Stern, Stewart and Company. This entire concept of EVA has been developed by this consultancy firm, and they are calculating EVA by this formula: OPAT minus TC into the WACC. What exactly do all these terms really mean? Yes, let's understand one after the other. First, let me understand what is OPAT. OPAT stands for operating profit after tax. Say PAT, in any case you understand, that is profit after tax. O stands over here for operating. We understand operating profit as EBIT, but they are saying operating profit after tax. So from EBIT you should deduct the taxes. That will give you the OPAT. EBIT is earnings before interest and tax. From EBIT, I deduct the tax, I will get my operating profit after tax. Okay. Question that arises is, what about the interest? See, normally what happens is, normally in accounts, what we do is we take EBIT. Okay, we'll take EBIT, and from EBIT, we will deduct the interest. Okay, we'll deduct the interest. Once the interest has been deducted, then you will be getting the EBT. Okay, and once you get the EBT, from that you will deduct the tax, and then you will get the profit after tax, and so on. This is what we normally do in accounts. Here I am not deducting the interest. I am taking EBIT and directly deducting the tax. So what should be the treatment of interest? Yes. Please understand this point really well. Interest will be classified into two categories. One is interest on long-term debt. Another is interest on short-term debt. Okay. Interest on short-term debt will be deducted. Interest on long-term debt will not be deducted. This is how you will work out the OPAT. So let us say you have taken some working capital loan. You are having some cash credit facility. All this will be interest on short-term debt deducted. Short-term debt is understood as debt which has been arranged for the operating activities of the company. So that should be deducted. But let us say you have issued 10-year bonds. You have issued 15-year debentures. You have taken a long-term loan. On that, you are paying interest. These are interest on long-term debt. Interest on long-term debt should not be deducted. Getting it? So deduct the interest on short-term debt. Do not deduct the interest on long-term debt. And once you have deducted that, deduct the tax straight away. And whatever answer you are getting, that is your OPAT. This EBIT you can even write as PBIT also. I have no problem with that. So if you are writing OPAT as PBIT minus tax, fair enough, no problem. But as I said, do not deduct interest on long-term debt. Do deduct interest on short-term debt. What is the logic of not deducting the interest on long-term debt? I will come to that also. For that, we will have to understand the concept of TCE. Once you will understand TCE, you will realize that why interest on long-term debt cannot be deducted. Okay, what is this TCE? Okay, TCE is standing for total capital employed. We say it is total capital employed, right? Capital employed. By capital employed, we mean long-term capital, right? Long-term capital. That will be your capital employed. So you will take here equity share capital. You will take here reserves and surplus. You will take here preference share capital. You will also take long-term debt. Okay, from the balance sheet. Okay, from the balance sheet, you have to take these figures and take a total. That will give you the TCE, the total capital employed. So you now have the TCE, which is the total capital employed. And now I'll just explain you that why this interest on long-term debt is not deducted. Okay, I'll try to explain you that thing now. See, what you are really going to do is when you calculate the EVA, just a second, I'll write the formula again and explain you that. When you calculate EVA, you will take the OPAT and then the total capital employed, you will multiply that by the WACC, which will be in percentage. See, total capital employed includes, please understand this, it includes long-term debt, right? It includes long-term debt. So you will calculate the total capital employed, multiply that by WACC. WACC is nothing but the weighted average cost of capital. When I calculate weighted average cost of capital, even there also I will consider equity share capital. I'll consider the preference share capital. I'll also consider there the long-term debt. So TCE will be multiplied by WACC. Okay. When TCE is multiplied by WACC, the figure that you will get when you multiply these two, the figure that you will get will be the expected profit. But please understand this. This expected profit is from the viewpoint of all long-term investors. Expected profit is from viewpoint of, right? It is from the viewpoint of equity shareholders. It is from the viewpoint of preference shareholders. It is from the viewpoint of also the long-term debt providers. You get my point? Total capital employed, I'm again repeating, total capital employed includes long-term debt. So when total capital employed will be multiplied by WACC, you will get expected profit. But this expected profit is from the viewpoint of equity shareholders, preference shareholders, debenture holders, bond holders, term loan providers. It is from the viewpoint of everyone who has provided long-term capital. So this profit should also be from the viewpoint of equity shareholders. It should also be from the viewpoint of equity shareholders, preference shareholders, and long-term debt providers. I hope you get my point. If from OPAT, if you deduct the interest on long-term debt, okay, let us say you calculate EBIT. From this, you deduct interest on long-term debt. Okay, you deduct the interest on long-term debt. Okay, and then you calculate profit before tax. And from that, you deduct the tax, and then you get the PAT. Understand? This PAT is from the viewpoint of equity shareholders and preference shareholders. It is not from the viewpoint of long-term debt providers because you have already deducted the interest that you are going to pay to them. This is the reason interest on long-term debt cannot be deducted. Otherwise, the two profit figures will not be comparable, right? TCE into WACC will give us the expected profit. OPAT that you have calculated is the actual profit, but both the profit should be from the viewpoint of long-term capital providers. So both the profit should be from the viewpoint of equity shareholders, preference shareholders, as well as anyone who has provided long-term debt. This is the reason that interest on long-term debt cannot be deducted. If you will deduct it, you will get profit from the viewpoint of shareholders. Then you know what will happen? This OPAT, which you have, right? This OPAT will be from the viewpoint of equity shareholders and preference shareholders. But in the TCE, I'm not including only equity shareholders and preference shareholders. I'm also including the long-term debt providers. The two figures of profit will no longer be compatible. And if they are no longer compatible, EVA is distorted, right? You will get a distorted EVA. This is the reason that interest on long-term debt cannot be deducted. I hope you are comfortable. Finally, how to work out the WACC? Yes. Weighted average cost of capital. Everyone knows how to calculate it, right? KO, try to recall, you must have learned in CA Inter that how we work out the cost of capital. Even in graduation also, you must have learned how to calculate the cost of capital, right? It will be cost of equity into its weight, cost of preference shares into its weight, and cost of debt into its weight. Cost of debt should always be post-tax, right? In FM, it is popularly known as I into 1 minus T. So when you calculate the cost of debt, always remember it should be post-tax. Even your OPAT figure is operating profit after tax. So the figure should be after tax. One more thing. Cost of equity, you should calculate on the basis of CAPM. CAPM, I hope it rings some bell, right? CAPM is something that will be used over here to work out the cost of equity. Capital asset pricing model will be used to work out the cost of equity. Cost of equity can be determined even on the basis of dividends. D1 by P0 plus G, right? That can also give me the cost of equity. But you should use the CAPM as much as possible. If you are applying the capital asset pricing model, then your cost of equity will be RF plus beta S into RM minus RF. RF will stand for risk-free rate of return. Beta will measure the systematic risk of the security. RM is considered to be the market return over here. So using this formula, you have to work out the CAPM. One more thing. Very interesting. One more thing, beta. The beta that you use over here, it should be the highest beta of last 5 years. You may wonder what all is really going on. Understand? As I said earlier, this is a concept developed by Stern, Stewart and Company. This is how they calculate the EVA. They have done their own research, and on the basis of that, they have come up with the concept of EVA. So whatever we are discussing is with reference to the way they are calculating the economic value added. What they are suggesting is that when you calculate the cost of equity, pick up the highest beta of the last 5 years. This will give you the maximum possible cost of equity. See, higher the beta, higher will be the cost of equity. So this will give us the maximum possible cost of equity for the last 5 years. And the moment you will apply that cost of equity over here, you will get the maximum possible WACC. As the WACC will rise, automatically the investors' expectations will also rise. So we will expect profit on a higher side. See, if you are giving a target to the top level management, obviously you should give them a higher target. Low targets they will be able to achieve. So maximum possible WACC will be determined. That we will apply to the total capital employed, and we will give them the highest possible expected profit target. If the top level management is going to exceed even those expectations, they are definitely eligible for reward in form of commission, in form of bonus, whatever it might be. But if they are not able to earn in excess of our expectation, we should tell them to forget about their incentives. This is the main idea behind calculating the EVA in this way. When the concept of EVA was unveiled for the first time, so many Fortune 500 companies, when they calculated their EVA, they were producing negative EVA. Negative EVA means you are destroying the wealth of the shareholders. Fortune 500 companies, right? Reporting negative EVA. That's the reason it has become such a popular concept in the West. You are putting the right accountability for the top level management. Simply you make profit and you get away with it. That is not proper. Earn profit in excess of the expectation of the investor. And when investor is exhibiting his or her expectation, it should be on a higher side, right? It should not be that we give them a low target. We should give them a high target so that they can take meaningful decisions which will ultimately achieve a profit higher than the expectations, right? So that's the reason we have this entire rationale. One more thing. When you calculate the WACC, you will require weights, right? Weights are required over here. In FM, when you calculate the weights, you have a choice. When you calculate the weights, you have a choice. You can go for market value based weights, or you can go for book value based weights. For example, what is the latest value of the equity shares? If the preference shares are listed, what is their latest market value? If any of your debt securities is listed, what is its latest market value? And based on that, I can work out the weights. These are your market value weights. Book value weights are weights which will be from the balance sheet, right? So from the balance sheet, I'll work out the weights. Stern, Stewart and Company have suggested that you should use book value based weights. Why? Why book value? Because when you calculate the total capital employed, right? When you calculate the TCE, where is it? TCE, yes, here it is. When you calculate the total capital employed, we are picking up these figures from the balance sheet. So since you are picking up the figures from the balance sheet, weight should also be based on figures in the balance sheet. Otherwise, they will not be compatible because you are selecting the equity share capital, preferential capital, reserves and surplus, the long-term debt, everything from the balance sheet. And then you say weights will be market value. The two will not gel with each other. Since the long-term capital is based on book value figures, let the weights also be based on the book values. So keep these different things in mind, and on the basis of that, you can then decide what will be the EVA. The company that produces the highest EVA, that company is best for investment. Okay, returning back again to that same question which was there, isn't it? Company A, B, and C are there. They all belong to the same sector. In which company should I put my money? Okay, which company should I put my money? If I follow Stern, Stewart, and Company, for all the three, I should work out the EVA. And wherever the EVA is maximum, I will like to invest in that company's share. So instead of all the other ratio analysis, instead of putting our own expectations, one of the easiest criteria now is based on the economic value add.